What's up guys, welcome back. I've got today's liquidity monitor fresh out of the oven. Look, the crypto market just hit a key inflection point. The short squeeze window we've been talking about? It's officially closed. But now, all eyes are on the Federal. In this video, I'm going to break down exactly what this means for your portfolio and the 3 most likely scenarios for the week ahead. Let's get started. Alright, let's kick things off with today's main event. The biggest story I'm seeing is the flip in ETH's funding rate. It just turned positive after 8 straight days in the red. That's huge. And BTC? It's been positive for 3 days now. So, both major cryptos are back to normal funding levels. What does this mean? It means the window for a short squeeze is officially closed. The market's resetting. But what's next? Let's check the data. Let's get into the numbers. First, the macro picture. The market's expectation for a rate cut this month? It's basically zero, at just 1.4%. The dollar index, DXY, is slightly lower, which is generally good for risk assets. Gold is holding steady near its highs, and oil is ticking up. I'm watching these macro indicators closely because they set the stage for everything else. Next, let's look at the crypto-specific data. Now, for the crypto data. Bitcoin's holding around $64,000, up about 1.6%, and Ethereum's at $1,680. The key numbers here are the funding rates. As I mentioned, both are positive now. That's a big shift from last week. Also, check out the Fear and Greed Index. It's moved up to 20 from 13. We're still in fear territory, but we're crawling our way out. This recovery in sentiment is something I'm watching very closely. Let's talk about the lifeblood of the market, liquidity. The on-RRP facility is stable at $454 billion, which is well above our key warning level. That's a good sign. However, bank reserves are still stuck below $3 trillion, which is a long-term concern. And the Treasury is still draining liquidity via the TGA account. So overall, I'd say liquidity is stable for now, but we're not out of the woods yet. It's a mixed picture. So, to sum up the liquidity situation, it's stable. We got some good news with the first positive inflow into BTC ETFs in weeks. That's a sign that institutional money is starting to come back in. But we can't ignore the long-term issues with bank reserves. It's a delicate balance right now. So, what are the key signals I'm laser-focused on right now? I've got 3 main ones. The strongest signal is the flip in ETH's funding rate, which we already discussed. The second is the slow recovery in market sentiment. And the third, the big one, is this week's FOMC meeting. Let's break down each of these one by one, starting with the most important one. This first signal is the most powerful one in my opinion. ETH's funding rate flipping positive after 8 days is a classic pattern. Historically, these longer periods of negative funding often signal a local bottom is in. So, this flip suggests the worst of the selling might be over. The catalyst for a short squeeze is gone. Now, we're back to a market driven by fundamentals and macro news, not forced liquidations. My second signal is the recovery in market sentiment. The Fear and Greed Index has climbed from 13 to 20. Now, 20 is still fear, but it's a big move from extreme fear. Here's the thing, historically, when this index bottoms out like this, it usually takes a few weeks for the price to follow. So, this is a positive backdrop for a gradual recovery, but don't expect a V-shaped rally overnight. And the third signal is all about the macro. We're in a holding pattern waiting for the FOMC meeting on Wednesday. This is the first meeting with the new Fed chair, Warsh, so his tone is going to be crucial. Typically, volatility drops off in the days leading up to the meeting as everyone waits for the decision. So, I'm expecting a quiet couple of days before a potential big move on Wednesday. This quote really stuck with me. It perfectly sums up the current state of the market. We're done with the forced moves, now it's time for the fundamentals to take over. Alright, so what happens next? I see three main scenarios. The most likely one, at about 50%, is that we just chop around between $63,000 and $66,000 until Wednesday. If Warsh sounds dovish, we could rally to test $68,000. But if he's hawkish and talks about higher for longer, we might see a dip back to the $61,000 to $62,000 level. These are just probabilities based on historical data, but it gives us a roadmap. Now, let's check for any red flags or anomaly signals. The good news is, I'm not seeing any major ones right now. All the short-term signals are actually converging and pointing in the same direction. The market structure is normalizing. Positive funding, positive ETF inflows, recovering sentiment. It's a pretty clean picture at the moment, which is a relief. But as always, we need to stay vigilant. Let me wrap this all up with a quick summary. Right now, the market is being driven by three things: the end of the short squeeze, recovering sentiment, and everyone waiting for the Federal. The most likely path is more sideways action until Wednesday. The key triggers to watch for are the FOMC result, the fear index moving above 25, and Bitcoin breaking through that $66,000 resistance level. So, what are we waiting for? Three key signals. First, the FOMC outcome on June 17th. Second, the fear and greed index breaking above 25, which would confirm sentiment is truly recovering. And third, Bitcoin decisively breaking above $66,000. These three things will define the next major move. So, to put it all together, here's my watch list for the coming week. Number 1, obviously, is the FOMC meeting on the 17th. Number 2, Bitcoin's reaction at the $66,000 level. A break above that would be very bullish. Number 3, the fear and greed index crossing above 25. And finally, keep an eye on the ETH funding rate to make sure it doesn't flip back negative. These are the levels that will guide my next moves.